Industrial Problem Seminar. It's a great opportunity to introduce John Dodson. John actually had some experience in our AMP program as a high school student. He then moved to Stanford University for his bachelor degree, and since then he has more than 30 years of experience in the quantitative finance industry. He's now working at the Option Clearing Corporations in Chicago, and he's going to talk about how much math do you really need to make markets in stock options.
Hey everybody. Hey Georgia, the Zoom room's open, right? And we're recording? Okay.
Yes, it is.
Okay, just so you know, we're recording. Yeah, very glad to be here. I was excited to get the invitation. I'm very glad to spend some time with you. One of the things that Gilad and I were speaking about over lunch is the sort of challenge that people in my industry face with respect to talking about interesting things that we learn in confidential settings. And I chose to approach that by talking to you about something adjacent to what I'm currently doing. And we can talk more about the clearinghouse later if you like, but what I'm going to talk about here is, oh great, thank you very much. Cool. Market making. And the title is an illusion. We're not going to probably be able to get too deep into it, but there's a lot of very interesting, sophisticated math that's being done right now with respect to modeling and the implied volatility of S&P 500 and the VIX and products like this. And I'm choosing in this talk to focus much more concretely, such as it can be concrete in finance, on the stock options, so options on actual assets. I'm also going to bring up this kind of notion of panel versus time series. And that I think that when you're dealing in stock options, where you're restricted to using data specific to the particular company that you're trying to risk manage, some of the theory that does get written about for a commodity such as the S&P 500 isn't directly applicable. So I don't know if any of you have background in the theory of trading S&P options or VIX or products like that, but that's kind of where, you know, all the mathy people go. So hence my title. All right, just to get started. So I have two affiliations at the moment. I'm with the Options Clearing Corporation in Chicago, executive principal in financial risk management. I am one of about 30 people with a math background that work there on the margining models that they use. The clearinghouse, the clearing corp is the central clearing corp. It's a monopoly service provider to all the options exchanges in America. All the brokers and dealers have to come through us to settle their trades, and we do all the risk management and the accounting and so on those trades. I also have, since 2007, been affiliated with CSE and the Department of Mathematics. I've taught courses for their master's program, and just, in fact, earlier this month, just organized the winter workshop in May. Participated in their winter workshop. Maybe some of you did as well. A couple of disclaimers. One, I should point out that this is my own, these are my views, this is my work. I haven't asked anyone in the Options Clearing Corp or the McFam to review any of this material. I'm not authorized by either organization to speak on their behalf. I purchased this data from the CBOE data shop, so I'm not using any proprietary data. The data remains their property, but I have academic use of it, which would include preparing this presentation. All right. I know a lot of you are interested in the broader industry. Minnesota isn't as close to finance as other parts. University of Minnesota. We have obviously insurance companies here. We have Cargill here, other commodities traders here. But we don't do a lot with the securities markets. So So I thought I would at least act as a bit of an ambassador from that world to kind of tell you at least my observations about how the sort of employment opportunities for mathematicians and other STEM graduates have kind of evolved. And it was funny, I originally had a slot here for the 70s because I was thinking about kind of Markowitz and the work that was going on at IDS with the original mutual funds. And I realized that that all happened in the 50s. So I don't actually know if there was anything going on for mathematicians in the markets in the 60s or the 70s. But I definitely know that the 80s was when the kind of quant world started. And in finance, the term quant is kind of a catch-all for really anyone with a STEM background working in the industry. The big kind of breakthroughs, I would say, that opened the field for mathematicians happened in the late 70s, early 80s. And it really did start with stock options, I would say. And some seminal papers on arbitrage-free pricing, the role of arbitrage, how arbitrage can be thought of in terms of risk-neutral measures, and then lots and lots of people bringing in interesting synergies from other parts of mathematics to talk about some of the more theoretical parts of finance. We'll talk a bit about Black-Scholes-Merton. Those are three authors who were thinking hard about what it means to value an option in a risk, in an arbitrage-free setting, which was a big innovation at the time. That I think probably kind of opened up the world for mathematicians and the explosion of derivatives that happened and such. The 90s, there's only so much room in the world for options. It's actually a relatively small market compared to stock options, I should say, relatively small market compared to others. The market for interest rates in the 90s was much, much, much bigger. And it started with LIBOR. LIBOR is an index of interest rates. It's been since discredited. It no longer exists. There were some people that got convicted for manipulating it, and the publisher has since quit producing the index. But back in the 90s, LIBOR was the basis for a whole bunch of interesting derivatives that were doubly complicated because the LIBOR was a whole term structure. So you had not just an index, but you had at each point in time you had an entire one-dimensional object. So you had a time series of one-dimensional objects. You basically had something that looked, a little bit like a string, and lots of math got applied to that. And there were questions about what sort of continuities would apply to LIBOR, continuous in term, continuous in time, so on and so forth. A lot of interesting math got written about what kind of degrees of freedom there were and how to model them for LIBOR. Brought in a lot of physics thinking as well. Starting in the early 2000s, I think that was really, the era then was about portfolios and the limits of diversification, and this idea of creating tranche securities for credit enhancement. So essentially gaming the credit agencies. Credit agencies at the time, even today, are still playing a role as sort of gatekeepers for what assets the big institutions would be kind of allowed to invest in. And what happened was essentially, initially probably by accident, the agencies started discovering that their models would allow them to provide higher ratings to pooled investments where there was perceived to be a lot of diversification. People started to gain this and figure out kind of what was the limit of diversification that you could provide. How could you manipulate the asset pool in such a way that the risk was still there, but it wasn't perceived to be there by the rating agencies? And that led ultimately to the, well, I shouldn't say it led to fragility in the securitized assets market, which exposed the marketplace and really the whole economy to the downturn in housing that happened in 2006, 2007, where some of these products started to fall apart. And there was a big turn away from securitization. In the second half of the year, as a consequence of that, there was all of a sudden a lot of interest in counterparty credit risk, liquidity risk, contagion networks. A lot of mathematicians and academics who were adjacent to these mathematicians were writing papers about these network effects and about how to build resiliency. Resiliency became a big keyword in the second half of the aughts. Also, you started to see explosion in volume around this sort of commoditized equity product. The S&P 500 is a large cap equity index developed here in the States and became a very popular underlying for initially a futures product. The futures product goes way back. The options product also goes way back. But starting in the 2000s, you started to see products that were based not on the return of the S&P, but on the quadratic variation of the S&P with volatility derivatives. And that market has exploded as well. And that market is still going very strong. And you see, so this talk is not about that. That's where the sort of cool kids are playing, the cool mathematicians. But it's a commodity, it's not a stock. Once you've created an index, you've created a commodity. And I wanted to talk about the sort of older, more classic problem of actually managing a stock option. In the first part of the last decade, I would say you started to see an interest increase. This is kind of a little bit of a dark ages for the quants, I would say. The early part of the 2010s, kind of post the mortgage crisis. A lot of quants ended up working in building stress scenarios to test resiliency. So the only way to test resiliency is to basically do war games. So a lot of quants got drafted into creating stress scenarios to do the war games. A lot of other quants got brought into basically a control function. So you would create two sets of quants. One would develop models and the other would criticize the models. It's nothing negative about it. It's sort of like peer review, but it's sort of a peer review kind of behind the veil. So you had to have a way to do peer review of confidential models using confidential data. And the way you do that is you create two divisions, basically the peers, and a lot of that model still exists. There was a foundational letter put out by the Federal Reserve in 2011 called SR 11, the 11th paper of the Federal Reserve, and it was about sort of setting the standards for doing peer review internally. A lot of roles for model validation, which is the name that's given for internal peer review. And there's also companies that now specialize in doing model validation for organizations. The other thing that happened was high frequency trading. I would say that really began probably the peak of popularity. There's still algorithmic trading today, but I think that it kind of the peak of hiring around high frequency trading and the support for algorithmic trading probably happened in the second half of 2010s. Then I would say, the first half of the 2010s. Second half of the 2010s, you started to see, continuing evolution on the S&P product side. Stress testing model validation kind of went away. People sort of found the limits of that. They still exist, but they're not big growing areas anymore. High frequency trading still exists, but now it's been sort of subsumed into just trading. And the new big ideas for the first part of the second part of the 2010s was crypto commodities and big data. I don't know. So there are certainly people looking at kind of the nexus of big data and automated trading with trying to understand basically sentiment indices using language models to figure out what people in chat rooms are saying and to try to figure out whether they can kind of get in front of potential day traders and so on and so forth. There are still people writing papers about that. Crypto has largely lived outside of regulated finance. There's been a couple attempts to bring crypto in. There's another attempt that actually just started this past week, where the SEC decided to allow certain certain basically stock products to exist that had cash crypto in them. We'll see what happens with that. So the crypto world, really as a consequence of being kind of kept out of finance, has developed its own, I would say, ecology, sort of separate from the finance. But there are a lot of quants who are going into crypto as well, I would say. But when they go, I mean, they sort of disappear off the radar, right? They go because they're no longer in the job pool and they're off doing something, I don't know what. And then maybe for the current period, I would say there's definitely interest in machine learning. My company has started to hire some machine learning people. We were talking over lunch. We don't really know what to do with machine learning people. We don't use any machine learning at the moment. I don't know anyone that does. Well, I should say that. I know that there's some people that use machine learning for calibrating really complicated models. Like some of this VIX derivative stuff that I sort of talked around earlier, some of that involves calibrating really ugly models. And it turns out that using machine learning as sort of high dimensional interpolators is interesting. But we're not using machine learning in my company right now, but we think we might want to. We don't know how, so we're kind of toying around with it. I maybe should ask questions. Does anyone want to talk? This is my last sort of slide on industry trends. Does anyone want to ask about industry trends at this stage? I'm going to keep moving then. So I want to give you kind of the lay of the land. I've got 2 slides on this before we get into the meaty stuff. For historical reasons, finance is very fragmented, and the different roles that exist generally don't employ the same people. A lot of these roles are, a lot of these legal entities roll up into holding companies. So they're like, if you think about a name like Goldman Sachs or Bank of America, they'll play several roles, but under different legal entities, and the staff don't really particularly interact. The main, for our purposes, I kind of wanted to draw attention to 5 different roles, really 4 plus exchange. So the exchange on the bottom, I'll start with that. Exchange is basically just a venue. It's really just real estate. And what they provide is an order book, a matching engine, procedures for settlement, and some sort of basic banking services around bookkeeping and clearing. But fundamentally, an exchange is real estate. The actors within that real estate really divide into, I would say, these 3.5 categories. Broker-dealer, for regulation purposes, brokers and dealers are essentially the same thing. The only real difference, so let me explain. A broker is someone who accesses an exchange on behalf of a customer. The customer could either be an individual or an institution, such as an investment manager. And generally, the dialogue is between broker and customer. But brokers also talk to other brokers. When brokers talk to other brokers, they're acting in a dealer capacity. So the dealer capacity it's almost like wholesale versus retail. Functionally, they're very similar, but it all comes down to sort of who is sort of making the market. And we'll talk about market making in a couple of slides. But the basic idea of market making is you have buyers and sellers, and the person doing the buying usually gets to do less work than the person doing the selling. The person doing the selling in this context could mean either selling or buying, but what it means is it means putting up bid and offers, putting up bid and ask quotes, so providing liquidity. So the modern term you hear is liquidity provider. So are you a liquidity provider or are you a liquidity taker? If you're someone who's looking to, you're not a professional, you're coming to get a derivative or a stock or something like that, you're a liquidity taker. You're coming to the market searching for liquidity. You've got money, you want a thing, they're going to provide the things for your money. The people doing the providing are called market makers. They're typically dealers or interbroker dealers, what they get called in England. And they're the ones that are talking to the exchange and putting records into the order book. The order book is showing where all of the prices and quantities are to buy and sell all the different assets that are for sale on that exchange. So the only real difference between a broker and a dealer is whether you're dealing with a customer, whether you're a liquidity provider or a customer. And brokers and dealers are regulated by the SEC. They're registered by the SEC. Generally, if you're a broker dealer, it's a highly regulated activity with a lot of disclosure. People don't like to be brokers. They don't like to be dealers. Hedge funds hate being brokers. There's barely any hedge funds that are brokers. They're not willing to pay the access. So basically, the other kind of wall is, in order to be a liquidity provider, you basically have to be willing to do essentially weekly reporting to the government about all of your activities and other things. It's a very hardcore profession. If you're just a hedge fund person, you do it kind of, you're using these people as a service. You're willing to pay a spread to do that, because otherwise you'd have to be a broker yourself, and then you would have to be registered as a broker. You'd have to give all of your financial statements every week to the SEC and so on and so forth. So that's the other kind of big dividing line. Now, investment banks, they're not regulated by the SEC, they're regulated by the Fed. And I draw the distinction here kind of, historically, there was the distinction between investment banking and commercial banking. Commercial banking, or just banking, is the activity of taking loans from a customer. We're not talking about banking at all in this talk, so I didn't even include commercial banking on the list. The role that an investment bank pays, the other thing commercial bank does is provide loans to companies. So if you're a big company, you're University of Minnesota or somebody, you need to borrow money, you have a couple of options. You can either ask an investment bank to issue to issue a bond on your behalf into the public markets or the municipal markets, or you can go to a big bank and say, Wells Fargo, someone, say, hey, I want to borrow $1 million. And then you enter into a typical banking relationship with, agreements and credit review and collateral and banking stuff. But the investment bank generally does not provide loans. The investment bank only provides access to the capital markets, in the sense that if you want to issue a bond or issue stock and use that public issuance as a way of raising money, then you'll go to an investment bank. So investment banks create securities. The underlyings are all created by essentially investment banks. And this is also it's not so much that it's a regulated industry, it's certainly regulated, but it's an industry with a very high moat. Silicon Valley has tried a couple of times to crack into this, because there's so much company creation going on the West Coast. They're like, why do we have to keep coming back to Goldman Sachs and JP Morgan to get listed? Why can't we, do it ourselves? Or why can't we do it through like a crypto initial offering or something like that? It never works. And I don't know why it doesn't work. It's a lot harder than you might think. Ultimately, the challenge that a regulator has with managing an institution's ability to create securities is that the regulator wants to maintain trust in the securities markets. They don't want there to be securities out there that are basically fake, which is what happened before the Great Depression. You had a lot of fake securities out there. And the Fed is sort of worried that if they let kind of anybody just issue bonds and stocks, then it could go back to that kind of, wild and crazy 1920s, where there's all this stuff out there that's unregulated, that has no value, that it's ultimately going to be fraudulent, that people are going to lose money and then say, government, where were you, and so on. So it's really about kind of that fear of the market being perceived as not genuine, that keeps the investment banks, keeps their moat wide. And then finally, you have the investment manager. And the investment manager is a generic term for really anyone on what I would call the buy side. So the four bullets below are all sell side. They're people providing markets or providing access to markets. Investment manager is a general term for any, really any institutional individual investor who needs access to securities. Why do they need access to securities? Probably because they're really for two reasons. Either because they have funds themselves that they're trying to invest to save for the future, or they do it as a profession and they're investing on behalf of somebody else, either as a family office or as a mutual fund company or as an ETF provider. There's a lot of employment, and particularly in Minnesota, when you think about kind of finance in Minnesota, we don't really have these four. We used to have some broker dealers here. We don't anymore, but we have a lot of investment management. In fact, we have an enormous amount of investment management, considering how small the cities are. It's very much a hub for investment management. And part of that is insurance companies. So insurance companies have a lot of assets that they need to manage. So insurance companies can also be investment managers. You look at companies like Ameriprise, they have both the insurance side and the fund side. So there's a lot of investment managers there. And they're the ultimate drivers of demand for the securities that are being issued by the sell side. So I want to talk about starting to hone in on the dealer in particular. I want to talk about the sort of feedback and value chains. Think about, from the point of view of, imagine you're a capitalist and you own an investment manager. So what is it that investment manager can do to increase your profits as an owner? Well, the first thing they can do is to increase assets under management. And that, by the way, is a role for a mathematician, because there's a lot of role in, frankly, sales. So when you think about kind of the James Simons of the world out there raising money for Renaissance, why are people giving money to Renaissance? I guess it's really two reasons. One, it's James Simons. He's a super bright mathematician. Everyone thinks he's the smartest person in the world, blah, blah. Of course you want him managing your money. So that's essentially bullet one, increasing assets under management by being perceived as someone worth investing with. And then there's bullet point number two, which is the fund performance. And the reason fund performance matters, doesn't matter very much. It's very much a second. I should have done it in a smaller font. AUM, assets under management, is the number one driver for the return to the owners of an asset manager. So that's what it's all about. But how do you get that? One way to get that is through performance. Performance is good advertising, which can drive assets under management. That's a feedback loop there. Performance in and of itself also brings some profit, in the sense that usually there's an incentive structure set up where the investor has a deal with the investment manager that the investment manager gets to keep a fraction of profits, or a fraction of performance less some benchmark, or something like that. So there's an incentive that's incentivized by this agreement that leads them to want to have higher performance. So that certainly does bring some revenue. But when you think about kind of the way hedge funds are organized, the majority, if not vast majority, of the revenue that a hedge fund gets is not from the performance, it's from the assets under management. So it's usually like a 2 and 20 deal, or a 2 and 10 deal, something like that, where you get 2% of the assets plus 20% of the outperformance. Well, 2% of the assets is going to be way bigger than 20% of outperformance almost all the time. But of course, if you don't continually do well, people are going to take their money away. So in order to maintain the AUM, you have to get the performance. So this is an aside, but that's an interesting feedback there. But it is worth keeping in mind when you work for an investment manager that the corporate goal is assets under management. That's what they're about. Dealers create value for their owners, and dealers are these broker-dealer entities, the specialized market makers within broker-dealer entities, buried inside big banks typically, like Goldman has a big dealer operation, Bank of America has a big dealer operation, ABN AMRO has a big dealer operation. They're mostly about getting their trades executed. So they're in a competitive market. There's a limit order book. You're not going to make any money if your trades don't get hit. So you have to have pricing that's competitive enough that you're getting hit, that you're the best bid or best offer in the order book when the deal comes through. But you also want to have a wide spread, because the spread is how you risk manage and the spread is where your profit is. You know, if you just buy and sell at the same price all day long, you haven't made any gross revenue. I mean, I should say you haven't made any net revenue. You don't have anything to show for it. So you want to increase your spread, but you don't want to increase your spread so much that you're no longer the best bid and best offer from time to time. And then, of course, there's controlling the risks, which is particularly relevant for an options market maker, because you have to deal with the eventual exercise and assignment that comes with the other side of the option. So this is kind of the invisible hand thing that's going on in this part of finance. The investment managers who are desperately trying to increase their assets under management through showing good performance, and through process and through having smart people and pretty lobbies and all of that. And then the dealers who are trying, and the dealer world is very oligopolistic. There's only a small number of dealers for any big asset class generally. There's not room for like 20 prime brokers. There's really only room for 3 or 4. So it's an interesting pressure, because you can't just sort of apply standard kind of asymptotic economics to this, because you've got 3 or 4 people. There's a tendency to divide the market up. So for example, ABN doesn't do certain stocks because they choose not to. They're not going to compete in that. So people will say, well, I'm either going to do this stock or not do this stock. And at any one time, someone's going to be kind of the dominant player in that stock. If they're the dominant player, they can widen the spreads. There's no competition. If those spreads get too wide, then someone else is going to say, you know what, it makes sense for me to start looking into this asset. So there is the economic sort of invisible hand is doing its job, but it does its job relatively slowly within that world, because it's just so expensive to do it. Basically, the barriers to entry are just so high. All right. So now we're going to focus even more on the market making activity itself. So market makers, as I said, they want to have competitive bids and offers. They want to do this as much as possible. This puts a premium on robustness and resiliency. So this is the big kind of cultural difference between a dealer and an investment manager. Investment manager who's using all these services, investment manager is willing to pay to use all these services because he or she has a good idea that they think is going to either do well or sell well. And they're willing to pay to do that. The market maker who has no public presence at all, they don't deal with customers, they only deal with brokers. There's only a couple of them, so they don't have to show off to anybody. For them, it's all about resiliency and process. It's everything, it's a factory, and they want that factory running 3 shifts a day. They'll open up offices wherever they have to in order to get the coverage they need. It's about process, efficiency. They don't know whether the stock's going up or down. They don't care whether the stock is going up or down. Why is there someone who wants this thing? It's everyone has a right to the pursuit of happiness. You don't know, you don't care. You're just doing your job, managing your risk, keeping the markets open. And it's a very different mentality on the sell side. That's what it's about. Like someone comes to me and says, wow, did you see, IBM earnings? What do you think? I'm like, I don't know, just keep bringing the stocks. It's a very different perspective. It's a manufacturing perspective on the sell side. And we don't see that so much in Minnesota because we don't have a whole lot of sell side firms here. But when you go back east, you talk to the people that are involved in this, either running the markets or as big brokers, big dealers, that's their perspective. I mean, the brokers will have a sales office where they have to at least pretend to care what the customer thinks. But internally, it's about keeping the place open and just doing the job and, putting up the tables, putting the wares on the tables and hustling. That's the mentality. Okay, we'll talk specifically about stock options. I can't assume everyone in here knows what a stock option is, so I need to go through this.
I have one question.
Yeah.
Is it like, so if you have some buyers and some sellers, how could you possibly arrange, like if there are no sellers of a stock, everybody wants to buy
Do the
it.
spread and you change the price. There'll be a seller eventually. So when you say there's no sellers, you mean at that price. But if there's a huge discount on, like And people will discount as much as they need to. You know, even a liquid asset like LinkedIn stock. You know, there was a time not that long ago, a couple of years ago, I know this because it was a challenge to our model, where LinkedIn fell by like a half over inside of a session. And it was because they had to find the price at which people were willing to buy this asset. There's going to be some price at which the buyers come out. And you just find that price.
And that is done by the dealer?
That's done by the market maker, that's done by the dealer. It's the dealer's job to find that price. That's what they do.
But it can never happen that somebody doesn't want to sell if it goes below.
Well, he looks at the limit order book, shows all of the interest in buys and sells at all prices. So if there's literally no buyers, I mean, like if the situation shows up that he looks on his screen and he literally sees no buyers, then he would put more bids out there below the lowest bid. And he would keep going until the buyers showed up. Now, if you have so you could say, eventually there are these things called stop losses. And you might be in a situation where the exchange might wake up. Exchange may say, oh my gosh, what's going on? Why are there no buyers to LinkedIn? If the exchange wakes up and says, we have a problem, the exchange could shut down LinkedIn, could say, no more trading in LinkedIn. We need to call the company. We need to find out what's going on. We don't know why there's no buyers. We're going to suspend LinkedIn for the next 10 minutes. And then they'll do 10 minutes of research, and then they'll either come back and they'll unsuspend it, or they'll say, you know what, we're done with LinkedIn for today. Market's closed on LinkedIn for today. No buyers or sellers in LinkedIn. So that happens on rare occasions. It happens all the time with little tiny companies. It happens on rare occasion with big companies.
Are those also called circuit breakers then?
Sorry?
Are those also called
The circuit breakers are typically, that's the language that I typically hear in context of futures, but yes, this is effectively where the exchange will suspend, will either halt trading or suspend trading for some period of time. So that's when, that's a kind of, so I guess you're right to bring it up. That's kind of the guardrail to the dealer. If the dealer really finds he can't function in the environment, you know, he could make a phone call and the exchange could say, we're done for now. We need to take a break. Or it could be that that LinkedIn will then make some public statement, because at that point the rules will bound. Eventually, because LinkedIn's a public company, they have SEC reporting regulations. They'll have to comment on why they got suspended. If they say, oh, the CFO just disappeared, we don't know where any of the money is, then, you know, they may say, you know what, we're going to delist LinkedIn. Which is an interesting challenge for people like us, because there's still options out there. And then you have to figure out what it means to settle an option on a delisted stock, which we have to do. But anyway, that's the broader answer.
So I mean, if the stock, let's say, is at 200, there are always people who make a bid at 100, so that who may not get in that day, but there'll be people you generally who make bids much lower.
Yeah, if you can get the price out before the exchange suspends you, then go for it. Yeah. Okay, so stocks in America, we're talking listed stocks here. These are exchange traded. There are other types of derivatives that you can buy from an investment bank. The listed stocks are puts and calls. And they're usually available over a range of dates and strike prices. If you don't like the strikes and the dates that are available, you can call the exchange and say, I want to create my own contract with a particular strike price and a particular date. They'll let you do that under something called the Flex program. So if your broker is party to the Flex program, they'll create that for you. That you end up paying a premium for that. Most of the time, the strikes and expiration dates that are out there are fine. The strike price is the term we use for the price which you're agreeing to buy or sell the asset on the expiration date or upon exercise. There's four kinds of these things. Well, there's two kinds of options. The call is the right to buy, and the put is the right to sell. So if you just think, I want to buy a stock, I want to buy 3M company stock, you could call your broker and say, I want to buy 3M company stock. What are the prices? Okay, done. If you say, I want to buy 3M company stock, but I don't want to do it today. I know I'm going to want to buy in the future, but I only want to buy if it's below a certain price. I don't want to pay too much. That's when you're talking about an option. So fundamentally, the underlying to this thing is a trade at some point in the future. That trade's going to have a price and a quantity. In almost all cases, the quantity is 100 shares, which is one lot. And it turns out with options that you can both buy and sell the right. So there's actually 4 profiles. There's buying in the future, and there's selling in the future. And then there's the question of which side has the optionality. So that translates into long call, which means I have the right to buy in the future. Short call, which means someone else has the right to buy from me in the future. Long put means I have the right to sell in the future. And short put means someone else has the right to sell to me in the future. And we think of these as distinct positions. Okay, let's move on. I want to talk briefly, how am I doing with time? Oh gosh, I can just speed up. I do want to talk briefly about an analogy to insurance, because there's a lot of insurance here in Minnesota, and I do think it's a useful analogy. So life insurance is more complicated. Let's set that aside. Let's talk about property casualty. Property casualty insurance, if you think about a policy on your car, policies on cars have expiration dates, they have deductibles, they have premiums, they have a defined interest, a particular VIN, for example. You can't sell your car insurance. You can choose not to renew it, but you can't sell back the policy you have. So that's a limitation. And you also generally can't buy car insurance on someone else's car because of course. I mean, otherwise you just go buy car insurance on that car there and oops. So, but basically fundamentally it's a marketplace for, protection of some asset. The big difference between the insurance world, which can't use risk neutral pricing, and the financial options world, which can use risk neutral pricing, is how they do their risk management. In the case of regular insurance, you're managing through a pool. So you have policies on a bunch of cars. And the theory is that if you have enough of these cars, and not every car is getting wrecked through the same event, so like you limit the amount of cars you have in all the floodplains, and you make sure that you don't have all your cars parked at the beach when the tsunami hits and so on, then you get some diversification. And if you have enough diversification, you actually don't have to think about the distribution of losses at all, because it degenerates and you just have a claim. You have the actual claim experience will converge pretty quickly in the number of policies that you wrote to the expected number of claims. Now, in the case of options, there's also this possibility of a degeneration of the risk variable, but it's something that only degenerates in the time series set, which means that you need to actively manage the risk in time in order to be able to have these different non-overlapping intervals offset each other. And that's what we'll be talking about, is that strategy for active management of the risk posed by an options position, which is a dynamic control problem. And I think I counted, I only have two equations in this slide deck, so we're not going to actually do any math. But I'm going to talk about the math. So, as I said, in options market, each position is individually managed and hedged. And this is kind of where I sort of maybe would start an argument with the sort of S&P and VIX commodity people, because their perspective on managing options risk is sort of a little bit closer to the insurance perspective, and that they're using different options to kind of hedge each other, which is fine. I mean, what they do is legitimate. But in the stock options world, we don't really. So what am I saying here? If I have options on, say, 3M, and I have options on, say, IBM, yes, there's some diversification going on between the IBM and the 3M. And this, by the way, is my bread and butter. So at the clearinghouse, we always deal with the diversification provided by different options. But you don't risk manage in a risk neutral sense. You don't value an IBM option because of something that's happening to the 3M option. You don't value a 3M option because of something that's happening to IBM. In insurance, you value the policies because of the whole universe of risks that's out there. So IBM, so you can't say, well, for your car, we charge you this, because your car is part of a pool. Now that pool might be a sub of the whole set of cars that you're out there, but you're not going to have a policy written on a particular car. And I think that the market makers, because they don't know where they're going to get filled in the other parts of their book, they can't count on there being a wide range of equities to do their risk management. They can't count on having like a big old diversified portfolio that they can hedge away en masse. They can't. They have to manage each one separately. Okay, so the paper that was written back in the 70s said the right way to, or said, here's a good way of thinking about how to value and hedge an option. And the right way to think about it is to set up a dynamic control problem. The dynamic control problem is we have, on the one hand, this option. We have, on the other hand, a marketplace in the underlying asset. There must be some strategy that we can employ where incrementally through time, through the management of this strategy, we replicate the outcome of the latter. We replicate the outcome of the former, the requirement at expiration, with the outcome of a trading strategy of the latter. So the idea is that you can develop this equivalence through replication. And not only that, you can do it so well that the replication is perfect and therefore riskless, which means you don't need to take into account any sort of trends in the underlying stock market. You can value your strategy as if the stock market was going up at any interest rate you want, because it's in all outcomes. It's not a risky outcome. Your strategy is going to be so perfectly built that it will exactly replicate. And in order to achieve that, you have to, of course, make certain assumptions. And the assumptions that Black-Scholes-Merton made were really these three. The bottom one being free of arbitrage. So we say that it's not possible to buy and sell, at two different prices instantaneously and make a profit. It's not possible to come up with a strategy that beats a risk-free bank account without taking any risk, for example. So assume that to be the case, which then creates this whole kind of possibility to bridge over into the world of measure theory. You assume that cash can be borrowed and invested at a single interest rate. So this is a little bit problematic because generally, remember, brokers are not banks. Broker dealers are registered SEC entities. They are not allowed to be banks. If they need to borrow money from a bank, they have to talk to that bank just as anyone else would have to talk to that bank. They have to have a deal with that bank. There's no way that bank is going to lend them and borrow them at zero spread. So there's going to be some spread that the dealer has to deal with that isn't factored into Black-Scholes. Now, in practice, because of their role in the securities market, broker-dealers can effectively create their own synthetic banks by trading with each other risklessly. So you can borrow directly from the dealer market without going to a bank. But even in that case, there's still going to be some spread that's paid effectively. And then the big assumption is around being able to model the total return of the underlying with a Brownian motion with a fixed diffusion rate. And that's the big assumption that people are like, eh. I mean, the riskless trading is a little bit challenging, but for many markets, I'm sorry, I didn't mean riskless, the costless trading, because here we're talking about the cost of trading, but in the underlyings, the cost of trading is pretty small. The sort of normal, sort of sophomoric quibble of Black-Scholes-Merton is the sort of normality of log return, or the log normality of returns. And that's actually kind of interesting, but it's interesting in ways that I don't think people think about necessarily correctly. Okay, so the recipe from Black-Scholes is that if, for example, you have sold a long call, and I haven't talked about this much, but there's actually two different expiration types in calls and puts. There's whether you're allowed to exercise early or not. So a call with the ability to exercise early, which is termed an American style call, is actually a little bit harder to price than a European style call. A European style call I don't know where the names came from, but European style call is a call where you can only exercise at expiration. The advantage of only exercising at expiration is that you can collapse time down and you can deal with it as a 2-point problem. You only care about what's happening right now, what's happening at expiration. With the American problem, you have to actually kind of solve the dynamic control problem, and which we can do. It's just that it's a little bit harder, and you don't get the nice formulas. But in practice, you have to solve the dynamic control problem anyway if you're a dealer, because you have to hedge. But if we set that aside and we pretend as if the early exercise was not a feature, then the way that you would construct your hedge or effectively manufacture an options position is through the replication strategy laid out in their paper, which is to buy this quantity, 100 being the number of shares times the normal distribution function of this ratio. This is the solution to the second order PDE that eventually falls out of the Bellman equation that you get when you set up a control problem. And again, it's a particularly trivial control problem because the replication is exact. So you don't have to have any sort of trade-off between utility function or anything like that. And what's nice about this formula, and the reason why this formula has lasted for so long, is because it essentially introduces a free parameter, that this volatility, this sigma parameter, was revealed by the option. So up until the option came into the problem, there was no concept of volatility. Volatility is something that you would tie to the option itself. And what that means is that it's effectively a free parameter. It's a tuning parameter. It's basically a fudge. And you can pick whatever number you want, which is called the applied volatility, to solve whatever problem you want. And a lot of people have made extensive use of that discretion to try to understand options. And in this case, we find we actually can't solve the problem within this framework. We have to jump to a slightly adjacent framework. But a lot of people have spent a lot of time trying to think about how to solve this problem within this framework and have gone off into the quicksand as a consequence. Okay, so the expectation is, we set up this little story, if you collect the correct premium up front, and I haven't given you the formula for that, but you can figure out what it would be, and you follow the recipe for hedging, we call it delta hedging, then after 2 years, almost surely you will end up with exactly what you need to meet the settlement obligation for any arbitrage-free exercise or assignment. And this particular recipe, where it's plus 100 times, applies to the call. And then for the put, it would be minus 100. I'm sorry, for the put, it would be 100 minus 100 times. And then for the short call, it would be minus 100. So this kind of trivial changes you have to make depending on each of the 4 different profiles. We call this protocol delta hedging because delta is the symbol that we use in finance for this first order sensitivity of the option price to the underlying. Okay, how much time? Oh my gosh, I don't have any time. So I actually wanted to do a case study. Let's flip to this case study. Should be able to do it pretty quickly. Let's talk about a particular option. Let's talk about the September 2023 put, all of the September 23 puts and calls struck at $100 that were issued. Basically, most of these were issued in September of 2022, but I don't want to go all the way back there. Let's start our exercise at March of 2023, which was 6 months before. So let's run a 6-month experiment where we're a dealer and we're making markets and we got hit on a long call, a long put, short call, and a short put. And now we have to risk manage these 4 positions separately. We can't offset them. Some background on 3M. 3M has scheduled quarterly dividends, $1.50 per share, paid on May 18th and August 18th, and it had quarterly financial results published on April 25th and July 25th. All right, so in the first example, we're just gonna set up our ledger. We bought, so we got hit on a long call, a short call, a long put, and a short put. So when I say hit on a long call, what I mean is we're actually short the exposure. We sold the call. Someone else bought a call from us, so we're short the exposure, they're long the call. We're market makers, so we're gonna charge more to a buyer than we would provide to a seller. So at the time, the spreads in the market were 9.55 versus 10, so a 45-cent spread per share. So on 100 shares, that means we got $1,000 of premium up front on the long call. We paid $9.55 on the short call. They paid us $955. We got $7.95 on the long put. We paid $7.65 on the short put. And at the time, the spot price was 102.40.42. So using that mid rate, the implied volatility rate by backing out the Black-Scholes formula was around 31.9% for the call, 31.5% for the put. Okay, so in the first case, let's just set up the delta hedge strategy and let's follow it. And we'll trade daily, every day, based on the marks, based on the bid ask in the stock market. We will buy or sell according to the recipe. If we go through that for 6 months, we find out that we blow through 718 of our $1,000 on the long call. We pay out $106 because 3M expired. Well, the closing price of 3M on expiration date was 101.06. So for a 100 call, that's $1.06 times 100 shares, $106. That's basically the net loss, so to speak. That was when they exercised, they made $106 if they were to subsequently sell their shares. So we'll write that as a intrinsic value. And that leaves us with a net revenue of $176. So this one worked out for us. We were able to go through all the machinations of the market, the 2 dividends, the 2 earnings calls. We were left with $176. Just under 2%. Sorry, just under 10%. For the short call, someone wanted the right to sell us this option. They did. We hedged it. They sold it back to us. We had to pay out $106. Oh no, we didn't collect enough. We were short $140. So we had to borrow $140 from someone else to pay ourselves for the cost of hedging this one. The long put, similar exercise. We don't have any cost at expiration because it expired out of the money. So our net revenue was $152, but the short put, once again, the short put left us at a deficit. So now this is pretty trivial. I haven't done anything here other than put in, using this formula with the information I've given you about 3M stock, these 2 dividends, and I put in these implied volatilities, 31.9 and 31.5. So we lost money on the short calls, the short call and the short put. We made money on the long call and the long put. Now, one way to think about that is maybe the volatility changed. Maybe the volatility shifted over the 6 months. What was happening in the markets? What was happening in 3M? They're involved in this settlement with the government about those things you stick in your ears. I don't know. You guys probably are closer to 3M than I am. But there's stuff going on that is going to affect their share price. And if the volatility came down over that period, and in retrospect, we know the volatility did come down. It actually fell by about 6% on both earnings calls. So the vol came down over the period. Then the person buying options is going to make a loss because the cost of insurance went down. So when we sold the short call, someone forced us into a long vol position and we lost money on it. So you could just say, end of story, vol went down, we weren't able to hedge our vol risk and we lost money. But I wanted to try to crack this. So let's go to the next round. The next round is, let's actually mark to market. I mean, this still involves mark to market just to calculate these numbers, but let's actually now recalculate the delta every day based on the volatilities in the market that day. So after the earnings call, you see the vol go down, you're going to use a different sigma in the formula. It's going to give you a different hedge ratio. This gives us, unfortunately, very similar results. We're still making money on the long call using the volatilities that were pathed out in the marketplace on the long put, but you're still losing money on the short call and the short put. So even though vols were going down and you were marking it down every day to the lower vols, you were still losing money. But something interesting, and this is kind of an aside, it turns out when you do that, you notice, or I noticed, anyone would notice, that about a week prior to expiration, the stock shot up to 106, and the options premium collapsed to 0, basically. What that means is that the call should have exercised, because you never want to hold a call once the premium has disappeared, because the only thing you can do is come back. The premium value, the time value of the option is a floor. If that hits 0 and you still have 6 days to go, the only thing that can happen, the only thing it can do is be bad for you. It can either stay at 0 for 6 days if you're super lucky, or it can rebound. And if it rebounds, then you didn't hedge enough. So when that happens, you're supposed to exercise. So let's say that you did exercise, in which case the intrinsic value was $624 because it was at 106.24 during that high. You made more money on the long call, but you lost more money on the short call. So it doesn't really change the situation in terms of you not being able to manage the short calls. Oops. So here's where I want to talk about something that gets speculative. All the broker dealers are aware that this phenomenon is out there. They all deal with it in a different way. I don't have any proprietary information. Some people talk about different techniques. One way to think about what's going on is there's a leverage effect. And the leverage effect really introduces an anticipation, but I'm not going to deal with the anticipation element of it here. But it's just, if we think of it as just a stylized observation, one of the things that we see in the market, and the econometricians saw this first, when stock prices go down, the forecasted volatility tends to go up. When stock prices go up, the forecasted volatility tends to go down. And this happens so that there seems to be some sort of a process correlation, negative correlation between the innovations in the stock, well, basically between the stock, innovations in the stock, innovations in the volatility. And some people have observed this and said, well, that explains the shape of the volatility curve and things like that, which I think is panel thinking, insurance thinking. I don't think it really helps us. But it does point out that if this stylized fact is sort of, true enough, we probably need to take into account that the volatility is going to go down if the stock price goes down, which means that the delta that we use traditionally for the Black-Scholes version of the dynamic control probably isn't the right delta. We probably need to be including a component where we anticipate what's happening to the volatility. So that's what I've done here in this next slide, is I've included this term, which we call vega in finance, times something that represents kind of the deterministic part of a stochastic process for an implied volatility tied to DS. So what would be the kind of anticipated drift in front of D, if I were to do D sigma equals alpha times DS plus something times DT plus some other motion, what would be that kind of coefficient in front of the connects sigma to DS, which is going to be presumably a negative number, because that's what we see, is that all tends to go up when the stock goes down. Notice that because the sign of this vega is either positive or negative, depending on whether you're long or short premium, and the D sigma DS is always negative, you know that adding this second term is going to lower the effective delta for all your longs and increase your effective delta for all your shorts. So this is a step in the right direction, because it suggests a way of sort of shifting money on our little balance sheet over onto taking money out of the profit from the long positions and putting it into the loss for the short positions. Unfortunately, it doesn't work also. And this is kind of where I ran out of time. This is midnight last night, by the way. So it's clock's ticking down, and I'm like, oh shit, didn't work. But it's much better. So now our loss on the short call is only 122, and our loss on the short put now is down to 47. And if I go back and compare that to what we had before, we had 87 before. So that 87, we've been able to reduce it to 47. So we're definitely going in the right direction, I think. Now, the next step I would take, you know, and maybe the next step you would take if you're so inclined, is to look at maybe the anticipated dividend due to the announcements. Like, we know in retrospect that the vol went down on the announcements. The market knew the vol was going to go down on the announcements. My model did not take into account that the vol was going to go down on the announcements. So it probably was over hedging ahead of those announcements. So I didn't see anything in the time series to suggest that we were making a lot of losses on the announcements, but that would be maybe something else you could look at. Okay, so here's my little aphorism. I was walking on the campus of the University of Chicago, and I saw this guy wearing a t-shirt, and the t-shirt said, well, that's all well and good in practice, right? Because you know the expression is, that's all well and good in theory, but, so his t-shirt was the opposite. His t-shirt was, that's all well and good in practice. And because I'm kind of a theory guy also, even though we all have to get our jobs done. I do think that this is interesting to think about, and it's probably worth, if someone hasn't already, reformulating the dynamic control problem to take this leverage effect into account. I don't think it would be that hard to do. The one thing, if anyone is interested in tackling it, the one thing I would point out is that if we want to introduce, it sounds like what we need to do is introduce skewness into our model for the stochastic piece. The problem with introducing skewness in this setting is we're dealing in logs here, which means that we have to be able to take expected value of exponentials, which basically means that we're limiting ourselves to the Gumbel class of random variables. And there are skewed Gumbels out there, like the normal reciprocal inverse Gaussian, for example, but they're pretty specialized and they're kind of clunky. So my guess is that there's a way to do this. My guess is that it's a little bit too hard and probably no one has tried particularly hard to write it down. But there could be a paper in there, I don't know. Thank you.
So instead of questions, because we ran out of time for questions, there's going to be a follow-up session, and you can just, in this room, so you can just stay and ask questions in this session or talk about other things. Okay, so yeah, thanks again, and those who need to leave for classes can do it now, and those who want to stay for discussion, just stay. Thanks a lot.
Is the Zoom allowed to stay on?
They can if they want to, yeah.
Zoom, if you have any questions, go ahead and share them.
Some of them left, but yeah.
Okay.
Anyone at home has a question? Okay, so yeah, we can keep it here. Just to be sure.
Question about the last part.
Yeah.
When you say adapting the stochastic model to simulate the skewness, do you mean like different than the Black-Scholes assumption?
No, I don't think that this, I don't think jumps help in this case. The jumps introduce a unhedgeable insurance component that has a lot's been written about, but I don't think that jump risk was material here. If you look at the time series, so one of the fundamental assumptions kind of underlying Black-Scholes is that time series sample paths of total returns are continuous. And I don't see any real reason to think that, even through the earnings announcements, that 3M wasn't continuous. I think jumps are relevant in certain settings, and obviously there's jumps associated with the dividends, but we factored that in. I don't think stochastic jumps help here.
Yeah, so it's about 7.
I'm curious about, so I'm a math grad student and have, like, no background in finance, so I learned a lot, so thank you for an interesting talk, and I'm sure I also like missed a lot. Finance stuff was new to me. I'm curious about like what kind of background your company or similar companies look for in math students, more on like the finance side than the math side.
Yeah,
So
fact and security, yeah.
we definitely hire recent grads in masters, recent grads in PhD. The PhDs we've hired recently have all done theses related to the industry. And for them, you know, the thesis kind of makes sense to us, so we're able to kind of make sense of that. We have hired PhDs sort of a little bit more speculatively. I mentioned that we're looking for machine learning people right now. We have some vague ideas about what a machine learning person would do. What we really want is we want someone to write a proposal to us about what they would do using machine learning in the context of our industry. So there's always going to be some of that going on, that kind of like postdoc type hiring where we don't really know what we don't know, but we're willing to experiment for a period of time. Otherwise, the jobs tend to be focused on kind of managing a library, so more technology. So we have separation between the libraries that implement models and the libraries that implement applications. And we hire software professionals to do the latter, but we tend to hire mathematicians and engineers to do the former. So, you know, that means to some extent like a software engineering type of a life cycle, but much more, but also with a kind of white paper, model review, model validation, sort of research component, testing component, model development component, kind of full life cycle in that, which to me feels very much like drafting a paper. So that skill set might be recognizable, but ultimately it's in service to, you know, a particular set of models that we use for risk management and for valuation, which is then maintained in a Java library.
Gotcha.
So, I mean, in terms of the skill set, you know, I mean, if we were to interview someone out of STEM who doesn't have finance background, we would probably look for analogies in terms of that kind of software ecosystem background, like large scale collaborative project work.
Thank you.
That's a bit hand waving, that's the best I could do.
Yeah, it's kind of a broad question.
This is a weird year. Yeah.
I'm wondering, so you said your company is essentially a monopoly on these types of trades?
We're not
No,
we are definitely a monopoly, but we're not a monopoly on the trades, we're a monopoly on the clearing of the trades.
Okay.
So all of the trades have to come to us. So these dealers will do trades with each other, but then the trade doesn't sort of exist until they get it cleared.
Gotcha.
And they have to tell us that they did the trade, and then we, the following morning, will reflect the fact that the positions have appeared in the respective accounts, and that it's being margined through the clearing bank that they've associated to that account.
Gotcha. Okay.
So we don't have any insight into why the trade happened or how we don't see the limit order book. We only see at the very end of the day, we see basically the same data that I was working with, which is the best bid and best offer at the end of the day. We don't see the range of offers and bids that were available. During the day, we don't need to. We know the transaction price, we know the end of day market conditions. We know the stock market conditions end of day. We see the prices intraday, we use that for margin calls, but we don't use that to like rerun any models or anything like that.
So you guys are not exactly dealers yourself, but
We're
you're
absolutely
just-
not dealers,
okay.
no.
How
Do you
does,
fit into one of those categories on your slide or?
We're the bottom, we're, pull up the slides again.
Yeah.
Georgia, should I close the Zoom?
That scares me.
Yeah, we can close it, that's fine, and I can actually have our communications coordinator cut it if we don't want any of these questions.
Oh, no, I see. We still have 4 people on.
Yeah,
I'm happy to leave them there if they want to ask questions.
okay, yeah, we're still good. All right, thanks.
Okay, let me share the slides once again.
Yeah, I'm still on, so we're still good.
Okay.
So, I don't know, we'll see.
So the question that was posed was,
Yeah.
like, where is my company? So we're the very bottom of the slide where it says clearing.
gotcha.
That's a job now.
We're here.
Gotcha.
So the brokers and the dealers will submit their trades. So it's a little bit different in options because there's 13 exchanges. But the exchanges have all consolidated their clearing into a 14th entity, so we're that 14th entity. So the exchanges are still providing the order book matching and the settlement. The brokers and dealers are dealing on those 13 exchanges, but then all of the clearing is happening with us.
Gotcha.
So exactly what sort of risk is being managed within the clearing purview?
So when you buy an option, say this example, 6 months goes by, you discover you're in the money by $1.06,
$1.25.
you want 3M shares. Who are you gonna call? You're calling the clearinghouse, you're calling us. Because you have no idea who you bought that option from. And what happened is after the trade gets done, the trade gets sent to us by the buyer and the seller. We turn it into 2 trades through a legal process called novation. So we become the buyer to the seller and the seller to the buyer. So if you're the buyer of a call, you're exercising, we're your counterparty.
Okay.
So we have to have the money to be able to locate IBM shares. To locate IBM shares for you.
Yeah, most people this week. So
We do about 10% of the daily stock market volume, I would say, maybe more.
So
The end of the day clearing or?
It's end of day. We submit trades to DTC at the end of the day.
yeah, so if a person exercises a call on a stock that is in the money and they're paying less than the normal price, obviously, then who is selling something for less than the normal price?
We
Is
are,
that-
the
Okay,
clearinghouse.
so you guys just have like a pool of stock that you own already to be able to sell back at a low price, or how does that?
No, because there's the other side too. The other side has sold the option. So we just pass it through. The only thing we have to worry about is the other side fails, in which case then we have to go locate IBM stock. Normally, we just take IBM side from the other side of the trade.
Gotcha. And there's like an approximately equal number of buyers and sellers in the options.
No,
market.
exactly equal. You can't clear a trade until you have a buy and a sell.
Gotcha.
I don't know that.
That makes more sense to me.
2 days.
Does that mean the spread that the clearinghouse company is getting is like less than the real spread in the order book?
The spread's not really relevant. Once there's a trade, the idea of spread is a concept within the exchange. Spread is a concept here. That's gone. By the time it's here, it's a trade.
Yeah.
You profit by like the
We're a nonprofit, we don't make any profit.
Non-profit.
Well, we're not technically a nonprofit, technically we're a regulated corporation with a dividend, but
They're like 400 each way.
we don't, profit's not our interest, so to speak.
That's not worth it.
We
Purely,
charge a clearing fee, we charge 5 cents per contract. So we're sell side in the sense that everyone in the world, including the broker dealers who buy options, pays us a nickel every time they buy an option. Or 3 cents, I forget, some number like that. We use that to cover our costs and to pay a dividend to the exchanges. We're owned by the exchanges.
So,
Kind of just function it right and not like making a.
you know, Iceland is.
Right, we're essentially a division of the exchange that provides this sort of matching service for expiration, for the exercise and assignment process. We also do all the books, so we keep track of who owns what.
For a single exchange or
Huh?
for single exchange, like,
There's 13 of them.
and your company is for a specific exchange? or
No, we
it's-
do for all 13. They have, all 13 options exchanges have to come to us by regulation.
Oh, by, I see. So you're a monopoly more or less. by
We're the
regulation.
monopoly and clearing for all the options
Is
exchanges.
that a result of legislation or?
Rulemaking, yes, but yeah, it's in the federal registry, it's a law.
yeah, it's sort of a natural monopoly. I mean, you're required to be a monopoly. It makes no sense to have multiple players in these kind of.
I mean, it could, there are other countries where they have multiple clearinghouses. The problem, the question, so the benefit with multiple clearinghouses is presumably they're more competitive, so maybe they can charge less than 3 cents. The disadvantage is twofold. What if one of the clearinghouses fails and the other one doesn't? And second, what if someone submits trades to one clearinghouse but wants to settle the trade on another clearinghouse?
Exactly.
And if you say, well, this clearinghouse is gonna handle this half of the business and this clearinghouse is gonna handle that half of the business,
Theoretic.
then and these are both for-profit companies, then aren't they gonna wanna fight for how much share they get, and are they gonna cut deals? And it's like, how do you organize it? At some point, there has to be something collective. So we're a quasi-national government organization, basically.
So the delta hedging problem that you described in the slides, does that problem at some point become a volatility forecasting problem?
Which one?
This entire problem
Yeah,
of being able to,
yes. Yeah, it probably is fundamentally about, I mean, the spread is supposed to cover the uncertainty and the volatility rate. But it's a very narrow spread. I mean, you saw what well, I didn't show you the bid offer was. Obviously, they're able to do it. What I don't know is whether they're able to cover their cost on every option bought and sold, or whether there is in fact some pooling going on. Like if you looked at all these results, like if you imagined that they were kind of equally good at doing all 4 trades, even in the last one. You know, if I add up these 4 numbers, I still get a positive number. So if they're able to offset the losses on these sold positions with the gains on these long positions, then you could say, for 3M they did okay, but that still doesn't address that. Now you're talking insurance. You're not talking hedging anymore. So the question in my mind is, why did the hedging not work in this case? And is it because the spread wasn't big enough? The spread here was, like, as I said, 45 cents on the call and 35 cents on the put. Was that spread not big enough to cover this cost because they didn't anticipate the volatility coming from those 2 earnings calls? Or were they just way better at hedging than I was? Which I would hope. I mean, I did this in like 2 days, so.
but like that's what I'm a little confused about. Is it just the problem of them not charging in a spread, or is it also that they cannot calculate the delta accurately enough for their hedging to be perfect?
Well, I don't have any insight into how they calculate their hedge ratios, but presumably they're better than I was. But I don't know, maybe they weren't, or maybe they weren't much better. But they have mathematicians to do this sort of thing, so That's why I thought it'd be an interesting industrial seminar. Applied math in action. Thank you. Yeah, I don't know what happens next. Georgia, what happens next?
I'm here. Everybody done?
I think, is everyone done? I think everyone's done, at least.
Okay, well then they can go and I'll just shut the tape off.
Okay.
John, thank you so very much.
Yeah, you're welcome. Enjoyed it. Oh, wait. Don't go away. That was a question on the
Okay, no problem. I haven't canceled it yet, so we're good.
Did your company, oh, wait, when did you ask this? 4 minutes ago, Huawei asked if my company faces any competition. No, we are a regulated monopoly. We have no competition. All right, thank you all.
Thank you very much.
That's pretty funny.